After inspecting your reports and accounts for potential errors, you may find that you need to make an adjustment. Some adjustments are made using what's called a journal entry. A journal entry comes from the old-fashioned method of accounting in which accountants use general ledgers. It's also called a general journal entry. I recommend leaving journal entries to your accountant. He or she can look over your year-end reports and probably spot errors you might not see, because that's what they do for a living. Most of the time, you don't need to worry about making general journal entries, but there are a couple of cases where you might want to use them. One of them is splitting up an account. If you want to change the way an account is set up, such as break up one account into 2 or more accounts, you need to use journal entries. For example, the sample landscaping company provides services for landscape design. The owner branched out and started to offer workshops on landscape design. To track the income from the workshops, the owner didn't set up an item for workshops and just used the design service item assigned to the design income account. Now the owner wants to track the workshop income separately. And to do this, you make a journal entry to debit the design income account for the amount that should now go into the new workshop income account. So let me just show you how that would be done. Go to the Company menu and choose Make General Journal Entries. So click in the Account column and choose the Income account for Design Services. And in the Debit column, type 1,000. In the next line, we'll choose Add New. We're adding a new income account to track the workshop income. So I'll call it Workshops and make it a sub-account of Landscaping Services. And since I know what this will map to, it's gross receipts and sales, I'll go ahead and select it. And you can see that QuickBooks already filled in the credit column to offset the debit in the Design Services account. Let's do Save and New, and I'll show you another use for journal entries. If the account was an expense account, you would credit the initial expense account by the amount you want to put in the new account and debit the new account with the same amount. But let me show you what I'm talking about. So let's make the account we want to split is Repairs and Maintenance Expense account. And currently that account has $977 assigned to it. And we want to make 2 new accounts to break up this account into 2. So we'll create a new expense account for maintenance and make it a sub-account of repairs and maintenance. And save and close. So you can see it's now a sub-account. And we want another account for repairs. It's an expense account. Call it repairs. And make it a sub-account of repairs and maintenance. And the maintenance account, I'll debit $420. And for the repairs, will be $557. And click Save and Close. And hopefully I did the math right. So in case of the new income account we created, we'll also have to create a new service item for workshops and assign the new income account to that item. So item, new service, call it Workshops, sub-item of Landscaping Services, and this is the new account we'll select. And the tax code should be none. Okay. Let's go ahead and close the item list. And I'll tell you about another use of journal entries. And that's when income or expenses have been incorrectly assigned. So if you assigned an expense to the wrong expense account, use a journal entry to fix it. For example, maybe you assigned your phone bill to the utilities expense account instead of the telephone expense account. In this case, you would credit the utilities expense account by the amount you want to put in the telephone account, and debit the telephone account with the same amount. Now let's talk about some end-of-year transactions. Your accountant will probably make several journal entries at the end of the year, so you don't have to worry about them. The journal entries might adjust for prepaid expenses and to adjust for cash versus accrual. Just don't be surprised if you see general journal type transactions on reports or in registers. Depreciation is another year-end item. A fixed asset such as a vehicle or a piece of equipment loses value as it gets older, and depreciation tracks the current value. Usually you enter depreciation at the end of the year so you can track it for your tax return. You'll also need a fixed asset account for each asset you want to depreciate, as well as an accumulated depreciation account for each asset. And depreciation is probably best left to your accountant because there are IRS rules that need to be followed. Okay, that's it for general journals.